Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for this Wednesday, September 23rd. My name is Ian Saunders, and also joined here today by Will Gibson. And Will, we're coming in today, heading towards the end of the third quarter. Got about a week to go here before we wrap up what has been quite a volatile month coming in here, at least for the S&P 500. I think we were talking before that there's been 9 trading days in this month that's seen the S&P have either a gain or a loss exceeding 1%, which is pretty substantial and definitely quite high relative to some other historical times. So I guess the market's trying to follow some of the volatility we've seen in the weather here over the past few weeks, at least down here in Richmond, Virginia. But coming in here and looking at the 20-point chart of the S&P 500, which is that main chart that we've continued to monitor throughout the past several months for this broad market benchmark, saw that benchmark climb up to new all-time high or at the beginning of this month at 3580, and subsequently seeing quite a big of a drop. Moving down to a near-term low of 3240 earlier this month before reversing back up into a column of X's in trading yesterday, actually, to a chart level of 3320. We're seeing a little bit lower level, about a 1% loss for the broader S&P 500, at least at the time of this recording today, but not quite enough to see it reverse back down into a column of those on this 20-point chart. So definitely seeing some near-term weakness displayed by the broad market benchmark, at least on this 20-point and figure chart. And that weakness has come, as I mentioned, we've seen a lot of volatility over the course of the past month. And as we look towards the next month, the month of October, it certainly, at least from a historical aspect, seems like this volatility is not going to end anytime soon. Coming in historically, looking at the average number of days during a month that the S&P 500 either gains or loses 1%. October actually takes the cake for having the most number of days on average at just under 7 days on average, going back to 1987, where the S&P 500 has a plus or minus 1% day. We're coming in last year, we're a little bit under that at 5 days during 2019, but unsurprisingly, 2018 saw quite a bit more, looking at 10 days. That the index either gained or lost 1%. But when we look towards how that performance typically does, obviously there's some big outlier years in there. But we had a piece in the Daily Equity Report there last week, specifically on Thursday, that looked at some of the performance breakdowns that we typically see in the month of October. And we actually see that volatility actually tends to lead to more positive days than it does negative days. Looking back to 1950. So if we take 1950 through 2019 and break it off into performance brackets that look at, okay, we have all these number of days, or the frequency. What's the frequency of times that we see gains or losses in specific performance brackets moving at every 2.5%. And so actually where we see the most number of congregation on these performance breakdowns actually comes in the 2.5 to 5% range that we see about 13 times over the course of the past almost 70 years at this point, that the S&P 500 has been gained between 2.5 to 5% during the month of October. So obviously it might be a little bit different coming into an election year. As we head towards the election there at the beginning of November, tend to see a little bit more volatility, sometimes some more downside in those 2 months leading up until the election there at the beginning of November. And Will, we were keeping track of a few indicators here before getting on the podcast that we're looking at where we stand in the state of things right now across maybe some of the participation across the broader market.
Yeah, definitely, Ian, and hopefully we can get maybe some of those positive skewed numbers moving into the month of October. September's been all over the place. If the market pushes to that 1% today, we'd be over 60% of the days in September over 1%. So a lot of uncertainty, a lot of volatility. Hopefully we can get that positive skew. But yeah, to your point about some of the indicators that we're looking at participation-based, beginning with, one that we'll talk a lot about is PT SPX, so positive trend for the S&P 500. That is looking at the percentage of stocks that are trading above their bullish support lines. So that's technical jargon for in a positive trend. This indicator actually held steady for a while through the month of August. In the beginning of this pullback, even in the beginning of September, this was still in a column of X's. However, recently we have seen it move down into a column of O's, which it now resides at the 70% level. So a few things to note here is that it took this a bit longer to reverse down than maybe some of us were expecting, given the sharpness of the pullback. And we can maybe attribute that to that a lot of stocks were trading on stems on their charts. They were well above their positive trend lines, and it took a fair amount of more price movement to get them down back below those trend lines. And even while that has happened to some degree, enough to get the chart to reverse here, we're still in high field position at 70% of stocks in the S&P 500, demonstrating that kind of absolute strength, trading above their trend lines. So a bit worrisome, we'll say. We do have a lower top on this chart as well. So not the prettiest picture, but we're still above, well above that 50% line. That's a typical demarcation of healthier market environments, I'll say. So we did get some movement down on that. Some other more shorter term indicators that we did see roll over prior to the positive trend that we'd like to reiterate. The bullish percent for the New York Stock Exchange, also widely referenced, that moved lower and has continued lower over the past few days. Also in a column of O's, now in midfield position. So PT, SPX, the trend is still in relatively high field position for the S&P 500. For the New York Stock Exchange, bullish percent. So the percentage of stocks that are on buy signals, that has fallen to about a midfield territory reading. So maybe what that means or what that looks like in an asset allocation strategy is, given the rest of the weight of the evidence, we're going to be still holders of those long relative strength leaders. So the names that have really propelled the market higher and sustained it through really 2019 and the beginning of this year as well. We're still going to be holders of a lot of those names, but some of those laggards, maybe that you got a bit of a bounce on, are close to your cost basis, or even a bit down. Maybe use those as some tax loss harvests. Using some of those positions to raise some cash right now to perhaps better yourself for a buying opportunity. So again, the weight of the evidence is still positive for the equity market. We're seeing some near-term weakness on the PT charts as well as those bullish percents. So make sure to monitor those as we move into October, as well as the election month in November and rounding out the year. So in addition to the indicators for the equity market, some other things that we've seen, if we want to call it breakdown, for lack of better words, is in the commodity space. So your precious metals starting out, looking at gold and silver. Gold, we were also talking about last week. It formed a triple bottom at 180. And to be more specific, we're talking about GLD, not the underlying GC4/ or the continuous contract. We're looking at GLD. And we had some support at 180. It has since violated that support and moved to 178. So that's the first sell signal for GLD since March. And today we're also moving lower on the chart for GLD, pushing down to below 176 now. So not the prettiest picture for GLD or for gold. We have a series of lower tops now, return to a sell signal. And in addition to that, we do have a negative score direction for GLD. So the technical health of that fund, we've also seen deteriorate in recent weeks. Nonetheless, we're still above that acceptable kind of 3.0 score line. So holding steady from that perspective, at least from a more longer dated allocation hold. Similarly, in the precious metals, looking at silver, we have a pretty similar chart, if I can use that word. Is going to be, we also returned to a sell signal earlier this week on Monday with a double bottom break at $24 for SLV. So that iShares Silver Trust continued lower, and today we're moving lower as well to $21.50 on that chart. This is also the first sell signal since March for SLV. Now, a point of distinction between silver and gold. Silver, SLV, looking at fund comparisons, SLV currently has a stronger fund score than gold. And in addition to that, it's still maintaining that positive score direction. So we are seeing some near-term breakdown on both of those charts, Ian, on the commodity space, as well as some of those equity indicators ticking lower. But hopefully things are going to hold steady right now before any major asset allocation moves would need to be made.
Yeah, absolutely, there will. And in continuing with some of the other alternative areas, or at least areas outside of the equity space, some other movement that we've seen here recently has been in the currency markets, and looking specifically at in the UK, seeing as the announcement came over the past week that the British Prime Minister was kind of moving back towards a more quarantine environment, probably for most of the next 6 months. Seeing the U.S. dollar British pound cross rate move a little bit higher over the past few weeks here, actually returned to a buy signal on a default point and figure chart on September 8th, and then gave a second consecutive buy signal actually just recently there on the 22nd. And in other currencies are showing some more near-term improvement for the U.S. dollar as well. Looking, I guess, outside of the UK at Europe, also the U.S. dollar euro cross rate also moved back to a buy signal after trading there yesterday, moving off a near-term bottom there as well. And we're seeing that follow through from several of these currencies displayed on the broader chart of the NYCE US dollar index spot, BX/Y as well. As we continue to mention throughout the podcast over the past several weeks in the podcast and in the written research that we have, we've moved into what has been a falling dollar environment. Dollar moved off of a high that we saw there in March, has given 2 consecutive sell signals on its default chart, and moved to a near-term low in August at 92 from a point and figure chart perspective. The past few weeks, I've seen a little bit of a return to the upside, maybe on the backs of some of these European countries or some other areas, potentially moving back toward the current quarantine state, as well as some near-term improvement in some other areas, leading to a 3-box reversal back up into a column of X's on this DXY chart at 93.50, and then with yesterday's move, adding another X there at 94. So one point that we continue to mention, the falling state of the dollar typically is some positive tailwinds for international markets as well as some areas in commodities. But it's definitely interesting to see that we see this breakdown in some of the areas within commodities coincide with the subsequent rally for the dollar here. So will be another place to keep an eye out for as we head into the month of October. To see if this is something that is going to be able to be sustained with this improvement from the dollar, or if we return to continue to move lower there for the broader U.S. dollar index spot. And with that, I mean, Will, there is no shortage of things that we're continuing to keep an eye out here for as we head towards the month of October, as we move towards the final quarter of what has certainly been an eventful year in 2020. I think that pretty much wraps up most of what we're looking to cover here today. But if you have any questions on anything that you're seeing or have wanted any kind of confirmation with moves that we see going on in the market, as we touched on throughout the podcast today, definitely a lot moving around out in the markets. And so if you have any questions on anything you're seeing on the platform or want to talk about what we're seeing from the Dorsey Wright research team, be more than happy to help you out. You're always more than welcome to give us a call for those of you that are subscribers at 804-320-8511. Or you can shoot us an email as well at dwa@dorseyright.com. So with that, I want to thank everyone for joining us here this week. Will, thanks for letting me hop back on here with you. I know you've been holding down the fort for the past couple of weeks here. So always great to get on and have a conversation here.